My name is Tim Gregory. I'm from Vermeer Investment Management. And the question that a lot of investors have been asking me in recent weeks is, why has the market rallied so strongly after being in such poor condition at the end of 2018? And obviously we saw the Christmas Eve capitulation when everyone was worried about what the actions of the Federal Reserve were going to be, what was happening with the politics of the market, and were we heading for a recession. And there have been three key drivers, I think, that have led the markets to recover in 2019 so far and start the year so strongly. Obviously, markets were very oversold by the end of last year, but we've had quite a good earnings season where over 70% of US companies that have already reported have beaten their earnings. And there's been a big shift in the dynamic of what people are now expecting from the Federal Reserve. We saw the rate increase at the end of last year and the comments from Jay Powell, the Federal Reserve Chairman, suggesting that they were on autopilot when it came to quantitative tightening. But that missive has completely changed. People now question whether there'll be any raise in interest rates this year and whether we've now seen the end of quantitative tightening and the Fed is not going to continue to shrink its balance sheet. And that's been absolutely critical to why markets have improved alongside better earnings and, of course, better hopes, albeit still to be proven, that the situation with respect to the trade talks between China and the US have been resolved. And clearly we have key meetings this week that will continue to frame the market from here. So I think two of the things that have pushed the markets on so strongly are now discounted. The earnings season that has been quite good and the news from the Federal Reserve, where we now see a much more benign outlook for interest rates. But perhaps the biggest question now for the market is what happens to the trade talks, because they caused an enormous amount of concern in markets last year, and particularly were a reason why the Chinese economy perhaps slowed as much as it did in the latter part of last year, and the knock-on effect that's had to economies like Europe, which of course has also been affected by Brexit negotiations. So how markets progress from here, I suspect, will largely depend on the shape of the trade talks that we see going forward and the politics of the market, which has become so much more important than it used to be. In the past, we've seen markets dictated so much by the actions of the Federal Reserve and central banks in general. But now the politics of the market and the actions of President Trump, the Chinese Premier, and the European negotiations with Brexit have become so much more important to framing the market. And I suspect that's what's going to take over the market from here. So in terms of the market, I think that we're still, from an S&P 500 perspective, still range bound from the peaks of the market that we saw early this time last year, around 2872 on the S&P 500. I think it's still going to be very hard for the markets to get out of that range. We saw markets down as low as 2350 on the Christmas Eve capitulation. Hopefully that's the bottom end of the range. But for markets to improve sustainably from here, we need to continue to see a strong message on the success of the trade talks, probably the Brexit negotiations as well, and that meaning that the economies globally will avoid recession and that will continue on the path of slow, steady growth that we've seen in recent years.